Hi everyone, this is Jason Baracco of Wall Street for Main Street. I just wanted to do a short video tonight that I thought warranted your guys' attention. It's based on an article that I just saw off of Zero Hedge today. It was released in the evening today, July 26th. Oh my God, guys, it's just unbelievable the amount of money these central bankers are flooding the markets with. So right after Brexit, let's just go timeline recap first. Right after Brexit, we get a statement from the Bank of England. I'll put this link up for you guys to look at. It's a PR statement saying that, our banks are well capitalized, they've passed stress tests, and yet, even though our banks are more capitalized since the 2008 financial crisis, we still, after Brexit, we're going to put 250 billion with a B billion pounds of additional funds into there just in case. If the banks are in such good shape, why are they doing that? Okay, so then we have the European Central Bank on their website about the expanded asset purchase program, talking about how basically they've been buying $80 billion with a B again. I'll put a link into this so you can take a look at the article for yourself, worth of assets per month. It's a mix of private sector banks, corporate debt, as well, and also government bonds. So it lays out some of the purchases here. Again, this is just what we know about. And this culminates in the main reason why I wanted to do this video right now is because Zero Hedge just released this story. Global central banks are all in, QE running at record 180 billion per month and rising. And this is from a Reuters report this story is based on, and it's interviewed an expert at Deutsche Bank saying that the European Central Bank and Bank of Japan are buying around 180 billion worth of assets. So that's not even counting the currency swaps. And they expect the Bank of England, due to Brexit and problems with the over-the-counter derivatives market, which is over 1 quadrillion, even though the Bank of International Settlements keeps lowering the total over-the-counter derivatives amount basically all the time now, saying, it's not a quadrillion anymore of gross derivative exposure, it's netted out, blah, blah, blah. I think it's probably actually increasing, not decreasing like they say in reality. But, look at the balance sheets of these central banks. The Federal Reserve, just the amount we know about on their balance sheet is over $4 trillion. So I think these central banks, they're trapped. I think they're beginning to realize it, and they know they're screwed no matter what they do. So they figured that they'd rather have, since they're Keynesian, they'd rather have inflation rather than deflation. The Zero Hedge article talks about why global asset prices are soaring while the fundamentals of the real economy, of the global economy, for many different reasons, are not doing well, are getting worse and worse and worse. So I think you should read these articles. I will put a link to all three of these. We are at 180 billion. So multiply that times 12. It's way over $1 trillion in terms of total amount of liquidity the central banks are putting in. Jim Rickards says the estimate is over 30 trillion since 2008 financial crisis that the banks have put into the system. It's probably even a lot more than that. Although, he's accounting for the currency swaps and things like that. And we know that Ron Paul got a one-time partial audit of the Federal Reserve. So we're looking at global central banks just flooding asset markets, trying to prevent asset market crashes. If asset markets do crash for 6 or 12 months, what's to stop them from doing this even more or going even more covert, even more backdoor QE? The only way I see this stopping with the Federal Reserve providing global liquidity is if the printing press is taken away, if the dollar loses sole world reserve currency, if the petrodollar is eased off, things like that. So it seems, the elites, the people in power, they want the SDR, which wouldn't totally reduce the dollar's power, would reduce it somewhat, but it wouldn't totally eliminate the dollar as a world reserve currency. It would be to a stupid basket. So, that would be very inflationary too. It would be just like Bretton Woods. Bretton Woods was sold to the people after World War II as a lie. It promised stability and all this other BS. It's, all currencies are pegged to the dollar and the dollar is pegged to gold. Henry Hazlitt fought that and said, no, this system is going to be very inflationary, just like, after World War I and the countries went off the gold standard, the real gold standard, and put on a gold exchange standard, and that was super inflationary. So we have a lot of potential inflationary here. global inflation that's coming. The central banks are trying to. They're talking behind the scenes, a lot of different central banks, about digital currencies that they can go to create new inflation. So the SDR and these global digital currencies could create, orders of magnitude of new inflation. This just adds into the global, the sophisticated control of inflation and taxation that I've said has been going on. There was also Lawrence Kotlikoff story that caught my eye. I will give you guys a link. It's on the Wall Street from Main Street fan page, Facebook fan page, if you want to go and see there. And he talks about how Social Security ran another $6 trillion deficit for the fiscal year. Well, what he expects, unfortunately, guys, is that your Social Security tax on your paycheck, if you're American, it's going to go up about 32%. So your take-home pay is going to be less and less each year, a lot. So you're going to have to be creative to make up for that loss of income due to a massive increase in Social Security taxes, massive increase in inflation and currency devaluation. You're going to have to build online businesses and find investments that can generate you diversified income. It is going to be very difficult. So this is just a short video, guys. We have rest of the week. We have a Welcome to Dystopia. Also coming up with Eric Dubin of the News Doctors. Him and I will be hosting that. And on Friday, as of right now, I also have Ronald Stoffele. He writes the In Gold We Trust report. He came out with his 2016 report, and I will be, he manages a gold stock fund, a gold and gold stock fund, and I will be asking him about his report and gold stocks. So have a great week, guys. But, these central bankers, they're trying to prevent deflation, fight deflation, especially asset price deflation. And, if there is a crash in asset prices, what's to stop them from, just ramping things up by more than $180 billion per month? This chart here is not even really counting the reinvestments by the Federal Reserve in their past QE programs. They're still reinvesting the treasuries, and the Federal Reserve's balance sheet is still growing. It's already over $4 trillion, and that's just on balance sheet. We don't even know what the stuff is off balance sheet with the currency swaps, because there is absolutely zero transparency with that. Okay, guys, have a great week.